Hey, good afternoon once again, Market Rebels, to our trading tune-up. We do this every Monday at 4 p.m. right on the closing bell. And before I get started, for those of you who missed cocktail hour on Friday, by the way, from our Miami event, which was absolutely phenomenal, but I'm completely worn out from it. But I got this fabulous trading tune-up hat from one of our Market Rebels, Frank. I'm not going to give his last name, but it is so appreciated. So if you're wondering, that's why we're going to have to retire the take hat going forward. So I've got my own trading tune-up hat. So for today, I wanted to revisit a topic that I've talked about in the past, way back, I think it was in May, and that is the three-strike pricing rule. But we're going to look at a little twist, because in that session, I talked about where the strikes were equally spaced. So maybe the 100, 105, 110, all separated by 5 points. And there's a certain mathematical relationship that absolutely has to exist. We're going to revisit that right now, just for a review, so that it will help you to understand what we're really here to talk about, and that is for when we get unequal spacing. So maybe 100, 105, 115, or 120. They're not all 5 points apart. And there's another, it's a similar relationship, but there's a little mathematical tweak that we have to do. And this is really important for all of you who do vertical spreads, and especially butterflies, because that's really the reason that the butterfly spread was created. One of the main reasons is to kind of do a pseudo arbitrage when these prices are out of line. And so for those of you who just throw up a butterfly and say, oh, it's because I think the stock is going to sit still, you're absolutely missing the point. And so that's what we're here to do for our trading tune-up today. So let's start with a question. We have 3 calls or 3 puts, not a combination, and they are identical except for the strikes. Now, by identical, I mean that they have the same underlying and the same expiration date. So for example, we've got maybe the 95, 100, 105 calls. And the question is, what can we say about the center strike compared to the other 2? Is there some kind of a mathematical relationship among these 3 strikes? Well, the answer is yes. But what is it? Well, we're going to look at the 95 call, the 100, and the 105 for this example. And again, they've got the same expiration. And what we're going to do is we are going to compare 2 hypothetical traders. So let's say that trader A buys the 95 call and the 105 call, and trader B buys 2 of the hundreds right here in the center. So notice what's happening. Trader A is taking these 2, one of each, and trader B is buying this one right here times 2. So both traders have 2 calls. They both have 200 deltas at expiration, provided that they're in the money. But again, the question is, how are these 2 portfolios going to compare? And that's what we need to understand to shed some light on this pricing relationship. So here we go. We've got various stock levels starting from 90 up to 110. Let's take a look at these strikes at expiration. So the $95 call with the stock at 90 is worth 0. 95 is worth 0. With 100, it's worth $5, right? $5 in the money, and then 10 and 15. Notice the 100, also worthless up to and including the 100 strike, and then it starts to go 5, 10, and so on. The 105 has a similar relationship. It's 0 up to and including 105. And then beyond that, it's going to start going 5, 10, 15. So you can see that these 5s are on the diagonal. And the 10s, if we extended this chart, would also be on the diagonal, the 15s as well. So they all can generate $5, $10, $15 worth of intrinsic value. It's just that the 100 is going to come into play first because it's the lowest strike call. We've talked about that before with some of the pricing relationships. Lower strike calls have to be worth more money. And that's part of the insights into this relationship. So let's take a look at Trader A. Now remember, Trader A had 2 options, one of the 95s and one of the 105s. So if the stock is 90, he's worth 0 here in green, and 0, he's worth 0. And Trader B that has 2 of the hundreds is also worth 0. Stock is at 95, they're both worth 0. But look what happens at 100. See, the 95 has now gone 5 points in the money, so Trader A is worth 5 at expiration. Trader B is still worth 0. See, that's the dividing line right there. A comes into play first because he's in possession of the lowest strike call. Stock goes to 105. A is worth 10. That's the 2 numbers in green. And B is also worth 10. Remember, he has 2 of the center strikes. And from that point forward, they will just continue to match. But what do you notice? Right here, that Trader A starts to take the lead. So Trader B cannot take the lead, but at some point they will eventually tie. So if we were to graph these last 2 columns, A and B, we would get this. Notice that the blue bars is Trader A, the orange is Trader B. And out here at the right, they start to match. But in the early areas right here, the blue bars exceed the orange. And this is the key. And that again is because the Trader A was in possession of the lower strike call, the 95. And so he starts to make gains before Trader B comes into play. So Trader A cannot be beaten. So what we're going to look at here is the relationship for if we have equal spacing. So Trader A had the 95 and 105. So a little bit of notation, don't let it scare you. I'm just going to use P for the price of the 95 call and P for the price of the 105. Whatever that market price is, we're going to add them together. And we're going to compare it over here to 2 times the price of the 100 strike. That's what we were just doing. And the relationship is that that Trader A that has 1 of each of the outer strikes has to be greater than, possibly equal to, 2 times the center strike. But he cannot be beaten. Might be able to be tied, but he can't be beaten. So we can also rearrange this. We can bring this 2 over to this side. We can say the price of the 95 call plus the price of the 105 divided by 2 has to be greater than or equal to the price of the 100. So this is a special case just because we have Trader B with 2 of these calls. So we know that these outer strikes, that the average of them has to be greater than or equal to the center. Kind of interesting. You wouldn't really, it's not intuitive. All right, so that's really the pricing relationship. So let's take a look at it according to a pricing model. Here we got the 95 call worth 642 and so on. Let's give it a shot. Let's put to the test. Let's see. And if we look at the outer strikes, this was Trader A. And what do you notice? If we add them up and divide by 2, that's 399. The question is 399 greater than or equal to 343? Yes, it is. Has to be. What about if we picked these 3, 100, 105, and 110? Take a look at the outer strikes. That was Trader A. We add them up, divide by 2. That comes up to 202. Is 202 greater than or equal to the center strike of $1.56? Yes, it is. What if we picked something like this? Now we're going to put gaps in them, but they're still equally spaced by 10 points apart. Let's take a look at the outer strikes. Add them up, divide by 2, comes up to 331. Is 331 greater than or equal to the center strike at $1.56? Once again, the answer is yes. And that will always be true. And so this is why you have to understand this relationship, especially if you're trading butterflies. And because butterflies are nothing but 2 vertical spreads, for all of you vertical spread traders out there, this is also critically important. because it can give you insights into where you might have an edge or might not, in which case you might want to avoid the trade. So for instance, let's take a look at the 95, 100, 105 butterfly. This is where we're going to buy one strike, the 95, sell two of the 100s, buy one of the 105s. And let's say that the prices are these. The 95 is 510, 100 priced at 320, and the 105 at $1.20. Question is there anything wrong with these prices? All right, now most traders, you show this to them and go, well, no, I know the lower strike calls have to be worth more money. They can't be greater than the difference between them, so they look fine. They're not fine. There's a very big opportunity in here. And that's because we could execute this butterfly for a 10-cent credit. The pricing relationship that we just talked about is violated here. This would create a 10-cent credit. And anytime you can execute a butterfly for a credit, there's no reason not to, because this is your risk graph. You've got a guaranteed gain. This is your 10-cent credit. But if the stock is somewhere in here, you're going to end up with even more money. It's an arbitrage. So this would be a time that we could either say that the 95-100 call would be valuable. We're selling the more valuable strike because it is relatively expensive. But we can do better than that we could actually create an arbitrage. And so that is a review of the three-strike pricing rule that we talked about months ago. But what we want to talk about now is, what if we have unequal spacing? We had some people asking this in the Q&A, and I thought, well, let's throw it out there. It's a good question. So let's say that we have, and just to make the math easier, I'm going to shift from the 95 call at the low position. I'm going to use the 100, 105, and 120. So notice that we have 15 points between the outer and center, and we have 5 points between the first and the center. So they're not equally spaced. And sometimes traders will say, well, now the whole rule broke down. Not quite. We just have to change the relationships. So here's what we're going to do. We're going to look at the outer strike minus the center. That's 15 points, right? 120 minus 105. And we're going to take the total distance. 120 to 100 is 20. And if we take 15 divided by 20, we get 0.75 or 75%. So we're saying that 75% of this distance is between the 105 and 120. And therefore, 25% would be the remaining balance over here. And if you want, you could step through the math and do 105 minus 100 divided by 20. We can take the shortcut. I know that if 75% is up here in the first pair, 25 has to remain. And this is what I need to know. These are my weights. And so what we're going to do is we're going to take 75% of the value of the $100 call price plus 25% of that outer one, or the 120. And now the relationship holds. This value, whatever it is, must be greater than or equal to the center strike. So what we're going to find is that first rule that we just looked at, where we said it was greater than or equal to the average, is really a special case. If they're equally spaced, you're just going to get 0.5 and 0.5 for the weights. So let's put this to the test. Here's a pricing model starting with a stock of 80 up to 130. Here's our 100, 105, and 120 strikes. These are the individual option prices. And over here at the far right is 75% of the $100 call plus 25% of the 120. So let's pick some and see if it works. Let's try the 90. If we take 75% of 43 cents plus 25% of 0, that's easy, that's 0, we get 33 cents. So the question is 33 cents greater than or equal to 12? Yes, it is. Pricing relationship holds. Let's try another one. What if we do the 95? If we take 75% of $1.42 plus 25% of a penny, comes up to $1.07. Is that greater than or equal to 52 cents? Yes, it is. The relationship holds. What if we go further up the chain here? We're going to take 75% of 1520 plus 25% of 201, we get 1190. Is that greater than or equal to 1070? Yes, it is. And what you'll find is that eventually you'll hit an area where they start to match up once they all start going deep enough in the money. So we're getting closer right here. We're getting at the very bottom 2526 compared to 2502. But if we kept pushing it, we would eventually find where they're equal. That's why the formula says it has to be greater than or possibly equal to, but it cannot be beaten. But the thing that's so interesting to me and for our coaches and professional traders is that there are really these hidden relationships that most people would never think to look. We would just never expect to see these things. But once you shine a light on them, you'll see this is the reason for the strategies. So if you find that you are one of these traders that says, oh, I'm going to put a butterfly on because I think the stock is sitting still, you are grossly missing the point. And if your results are reflecting that, it's not a bad strategy. It's just because you don't understand the mechanics. And that's what we're trying to help you with trading tune-up. So I hope that gave you some things to think about. So remember, it's about understanding what makes a strategy tick. It is not just about saying, I know the definition of a butterfly. It might get you started, but it's not necessarily going to get you to profits. So for anybody who would like to understand more about trading and some of these inside tips, please take advantage of this offer. It's a free 30-minute one-on-one consultation with one of our world-class coaches. You've already seen some of them in Coach's Corner, which we will start back up this Thursday. I know we've missed the last 2 weeks. But we're going to start up Thursday, and Stu and I have got a fabulous one Thursday at 4 p.m. But these are the people you'll get to talk to. And so it's a free 30-minute one-on-one assessment, and the phone number is 888-809-8058. And give them a call, absolutely no obligation. Have a chat with them and just see how they can help you. And with that, that's all I have. So again, I hope you learned something. That's always our goal here. And thank you again, Frank, for the hat. It is absolutely fabulous. Love it. And we'll look for you on Thursday for Coach's Corner, 4 p.m. We'll see you then.